Hello, everyone. This is Ron Corser again with Cornerstone Retirement Partners. Continuing our talk about an income plan, how it differs from an investment plan when you're planning for your future retirement. It's important to understand a couple of key concepts. Number one, the income plan is what creates in retirement your investment plan. You have to pick things that will give you the income you need over time with the least amount of volatility, the least amount of downside potential loss, the best potential success going forward. So in thinking about all this, the direction your money, how your money is moving matters as much as the direction of the market. And we're going to go through an example that talks about sequence of returns and perhaps clear up some of the myths about return over time. But keep this in mind. Volatility can be a real benefit to you while you're working and putting money into your retirement plans. Volatility can be a real killer in retirement. So let's take a look at this going forward, how volatility matters. So here's an example. Starting off, this goes from 1999 to 2019 actual market returns. All we did was take the S&P 500 and what it did over time. And you're starting with $1 million. And everybody says, wow, you made it. You got $1 million saved in retirement. You're going to be in hog heaven. And we're going to take out 4% a year, starting at $40,000 a year, and increase that by about 3%. So if we go back over time, we're just in an S&P 500 fund. Nothing fancy here. We see that 1999 was a great year. We had three bad years there. It reduced our year-end value. The market bounced back. It always does. 2008 was a horrible experience, and we keep going down. The market's gone up. So we look at 20 years, and we had basically 6 down years and 14 good ones. And we're still taking out money. But at the end of that 20-year period, instead of $1 million, we only have about $148,000 left. How can that be? I mean, how can that really happen? But it's true. This is just absolute market returns. So the interesting thing about this rate of return is that over the 20 years, the average rate of return for the S&P 500 was 6.48%. And yet we have a whole lot less money than we started with. So anybody in this retirement plan who's followed this, 20 years later, if they retire when they were 60, when they're 80 now, they perhaps are running into some financial trouble. So write down these two numbers, 6.48%. You started with $1 million. We're taking out $40,000 a year, beefed up by 3% a year. And at the end of this whole time, through 2019, we have less than $150,000. That could be a calamity waiting to happen. So let's take a look at another approach to this. So again, that's 6.48%, less than 150,000. Here's another example, same time frame, a little different strategy. The strategy was based on let's make sure that volatility doesn't kill us in retirement, because what we just saw in the S&P 500, volatility was a killer in retirement. Here we have an example where there's one down year in 1999, another down year in 2013. These are real life examples. We start with the same $1 million, same $40,000 withdrawal, beefed up by 3% a year. So at the end of 20 years, we got about 943,000. What's the difference? And this is critical because the average rate of return is actually less. This is only a little over 5%. But we have more money. How in the world is that possible? That can't possibly make sense, but it makes great sense because in this second example, the volatility of the retirement plan has been really minimized, hasn't it? So keep in mind these numbers, 5.4%, started with $1 million, taking out 40,000. We end up with almost $1 million after all this time. The account balance, pretty good. So what's the difference? Think about this. We talked about it before. When you're working and you're dollar cost averaging into retirement and your retirement accounts, volatility can work for you. Yeah, there's some really bad times, but over a long period of time, you end up generally recovering. So the S&P averaged a rate of return of almost 6.5%, reduced the value of this retirement account because of really volatility that was not accounted for. The other part that we used in this other example was the U.S. Aggregate Bond Fund. Nothing fancy. Both of these are two basic index funds. That's all they are. And yet one did substantially better in retirement than the other. Why? Volatility. Volatility is a killer in retirement. So the key in retirement, you create an income plan and then you create an investment strategy to beef up that income plan with the idea that you reduce volatility. If you can reduce volatility more and more and more, the chances of you being successful in retirement, meaning you're not going to run out of money or have to adjust your lifestyle downward because of what's going on, just goes up dramatically. Your potential for success goes up dramatically, reducing volatility. So, ladies and gentlemen, you think about it, how can you average in this example almost 1.5% more and you end up with less money? It's volatility. It benefits you. Don't chase volatility and high returns in retirement. You don't need to. You really don't need to. All you need to do is reduce volatility and make sure you have the income plan to support your retirement lifestyle. And the income plan is what creates the investment plan. So if you have any questions, you want to talk more about this, give me a call. Again, I'm Ron Corser with Cornerstone Retirement Partners, 616-301-2581. That's 616-301-2581. We'll go to our website, www.cornerstone-rp.com. That's www.cornerstone-rp.com. Put your information in there, and we'll reach out to you and get you the information you need to make really good decisions for yourself and your family. And today's program and these blogs are also available on our website, along with past programs that we put on. A lot of times people tell me they keep watching some of these, and over time, they're able to make really great decisions to help themselves going forward. So I encourage you to do that. Thanks again for listening.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement. Visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.